Welcome to week 9 of Principles of Innovation and Entrepreneurship. This week, I'm actually going to be live broadcasting from Cuba, where I'm on a short trip just to look at the economic climate in Cuba, try to understand the potential climate for entrepreneurship. That's, of course, too complicated to go into in any depth at this point. But it's a very interesting place. I had the pleasure of being able to go into the Soviet Union in the days before the Iron Curtain came down, and then going back year after year as the Eastern Bloc opened up, as the Soviet Union dissolved, as Russia was formed, as the Czechoslovakia, Hungary, East Germany, each gained their independence, and then East Germany reunified with West Germany. The Czech Republic, Czechoslovakia divided into the Czech Republic and the Slovak Republic. The Baltic republics, Latvia, Lithuania, Estonia began to develop. So I've had a really great chance to look at economic systems change. And I really felt that I wanted to go to Cuba to see that as well. Now, because I was not sure what the bandwidth situation might be for the live broadcast from Cuba, I have decided that I will begin by recording this video offline, which I will put up on Blackboard so that you can have the opportunity to see this class, even if my Wednesday evening live online chat doesn't work out because of bandwidth limitations coming from Cuba. I'm going to still be online Wednesday evening if bandwidth allowing, and I will be happy to take questions at that time, talk about the course, and so on. But this pre-recorded video will also be available in case that is not able to be done. So it's interesting that this time we're talking about financing or funding, which is an interesting thing to be talking about coming from Cuba. But it's something that all new ventures need to think about. This doesn't matter whether your new venture is a charitable new venture, whether it is a social new venture, whether it is a for-profit new venture. Financing and developing financial sustainability is something that you have to think about and that you'll have to be working on. So let's just talk a little bit about that. The climate for financing and funding is changing all the time. The graph that you see in front of you is a graph of the venture capital that has been available to new ventures over time. On the left side of that graph, you can see that there's quite a peak there, and that corresponds the way up to the dot-com boom and the way down to the dot-com bust. Which has become a kind of a famous time in the history of finance and economics, when there was so much interest in the new dot-com new ventures and so much money pouring into them. And then the correction occurred, the dot-com bust occurred, and so many companies went out of business. Now, this is not that unusual when any kind of a new time or new technology comes in. Automobiles were like that. There was so many automobile manufacturers, and eventually it sorted down to just 3 in the United States. There were so many, television manufacturers, and it eventually sorted out. So this is kind of the normal behavior for economic cycles. So let's talk about how is it that you get financing or funding for your ventures, and what do you need to do? Well, the very first thing you need to do is to realize that you have to have some good data. Those that watch Shark Tank, and I know I refer to that often because it gives you just a short opportunity to see this in action. It's a little bit artificial in the sense that it all happens within a few minutes, but it shows the general aspects. it shows that one of the things that people have thought about when they come in is what are their capital requirements? What are you going to need for your funding for capital items? It could be facilities, it could be equipment. What other capital items do you need? You also have operating requirements. You're going to need to buy raw materials, perhaps. You're going to have to pay salaries. You're going to have to cover operations. You're going to have a sufficient cash flow to do that. But one thing that you will be asked is, when do you expect to break even? That means, when do you expect that the revenues you receive from your customers will exceed the expenses that you're incurring to provide your product or service? And being able to tell them that will be very, very important to you to be able to raise money. The next point is, what is the overall attractiveness of the investment? Does the investment look like it's going to return enough profit to make the risk worthwhile? There's always risks if you're investing money into any kind of enterprise. And so you better figure out what that risk is, how you can mitigate that risk, and what the potential reward is. If the reward is very large and the risk is very small, life is good. If the reward is very small and the risk is very large, life is terrible. If your reward is small and the risk is small, it's probably not enough to interest an investor. Certainly on the Shark Tank, you see it often happen when individuals come in and the investors decline to invest because they see it's just not enough return. So these are the questions you have to be prepared to answer. The next question for you to answer is, where will you go to get the money, and how will you do that? Now, we've talked about a lot of the aspects of starting a new venture, including the marketing aspects, the business planning, the lean launchpad, business models. Most of that is set up so that you can understand your business well enough to tell someone else why they should pay attention to it, why they should invest in it. Now we're going to say, where do you go to get that, and how do you kind of close the deal to get them to invest in your new venture? In order to do that, we have to consider various financial objectives and various ratio analysis. There's a jargon in this business, and if you don't know the jargon, if you don't know what ROI means, return on investment, you're going to be at a tremendous disadvantage when talking to the investors. If you don't know the cost of your customer acquisition, that they're going to be at a tremendous disadvantage. So we're going to be talking about that a little bit in this chapter, but for those that would really like to learn more about it, I suggest you take a look at the link that I have here that you can find on my website as well, in Technological Entrepreneurship Financial Analysis, which will give you much more detail of all of this. Okay, so you think you want to raise money, and we've already said step one, determine the resources you need. You're either going to do a business plan, a business model canvas, or use the lean launchpad model, or as we've done here, and it's due this week. Remember, it's due this week. You have to turn in the hybrid business plan, which includes a business model canvas and is built a little bit around the lean launchpad model. As Steve Blank likes to say, you're going to have to get out of your office. You're going to have to talk to potential customers in order to be prepared to go and raise money. You may also want to almost undoubtedly will want to have a group of advisors where you can brainstorm with those advisors and find out before you're talking to an investor what the obstacles are going to be. If you can find those out and be prepared to address them, you're going to be in better shape. Then you estimate the financial needs and clearly state the assumptions you're using, okay? Because you will have to have assumptions. You're going to have assumptions of how fast money's coming in, how many of these things you're selling, how much it's going to cost to produce whatever it is, and you're going to have that sales forecast and determine the break even. And you can then finalize your estimated cash needs. Okay, Let me give you some examples of assumptions. Um, you're going to be able to, you have to defend every number that you provide to an investor. A typical assumption might be we're expecting an inflation rate of 2.5%. Okay? Another assumption might be the cost of the main raw materials will be constant over time. Or not. It might be we expect the cost of main raw materials to be going up at 3% per year. It depends on what your raw materials are. Um, Another assumption, you're expecting to hire certain people at assumed salaries. So you're going to talk about why you need those people and what it's going to cost to acquire them. You're going to have an assumption on initial sales in the first year will be X. Your annual growth in the first few years will be Y. And your growth in expenses is expected to be Z. Now, obviously, Z needs to be less than the sales and growth. If your growth in expenses is more than your growth in revenue, you're going to have a very hard time ever achieving break even. Now, for the first few years, your expenses are likely to exceed your revenue, and investors are going to be fine with that as long as they see a path toward balance over time. You really want to see that expense growth less than the revenue growth, and that's the way you reach profitability. And then once you pass that, then you have the potential to achieve economies of scale where your revenues grow much faster than your expenses. And that's kind of what an investor is looking for. What are the startup resources you might need? We've already talked about the people, the founding team, advisors if you have to compensate them. Many will do it pro bono. Independent contractors that will do things for you. You may need physical assets, equipment, inventory, office, plant space. You may need to have a financial emergency fund available with the startup resource. You also have complex resources that you're working with. Some are utilitarian. You may have a product, we have a patent on it. That's a tremendous resource. Great to have it. You may license a patent from somewhere else, another great resource. You may have other kinds of intellectual property. That's a complex resource. You may have instrumental resources, meaning that because of who you are, you have industry contacts, networks, and potential partners. That was a huge benefit to me in founding iLink because I had the industry contacts, I had a network, and we were able to have partners with some pretty good companies like, for instance, IBM and others early on. News Corp was one of our partners. You may have intangible resources, a particular culture, or some tacit knowledge that something that you know that most people don't know. That's going to be a resource to you. So you go through and you estimate all those expenses of buying equipment, long-term assets, capital, operational expense, the production costs, and so on. So that once you have done that, and we have been through this, you divide them into fixed expenses and variable expenses. The fixed expenses are going to be kind of a high wall that you have to get over. Until you have enough revenue to cover the fixed expenses, you're going to be running at a loss. The variable costs scale with whatever it is you're making. If you are delivering the Tesla new car, your variable cost would be the cost of all of that, the materials that go into the Tesla, the batteries, the steel, and the other goods that go into the Tesla. Whereas your fixed costs will be the cost of the plant where you make the Tesla. Once you make the first Tesla, right, every succeeding Tesla, the fixed expenses don't go up, but the variable costs, and you're going to need to sort out your costs to know how those things go forward. Other fixed costs include, utilities, the manager's salary. It could be that advertising is a fixed cost, although a part of that can also be variable, insurance, interest, rent, depreciation. Oh, you might be wondering why this picture is on here. And that picture's on here because every year I go down to spring training and we have a UMass day with the Red Sox. And every year I pose with Wally. This year is no different. And I just kind of love this time of year and have this opportunity to be with the UMass alumni and also with the Red Sox. Lots of fun. Okay, so those startups need funding for all the reasons. I've already gone through this. Some are early stage. That's the first category here. Sometimes a startup has a long period of product development where money isn't coming in. This is really true for biotech startups because you may have to invest $1 billion. We looked at Prevo Technologies. They will have to invest $1 billion to get one product to market. They'll probably sell the company before they invest that $1 billion, and the last part of the billions will be invested, but they've already invested many millions, and they have essentially no revenues. That is pretty typical. These kinds of things can lead to real cash flow problems. So the other way problems can occur, is because the cash comes in bunches, but the expenses go out regularly. You know, employees have this funny thing that they like to be paid every couple of weeks, and but businesses that are ordering your material may pay you only on a 90-day delay or something. And so you may need to go find funding to cover that float during the time you have to pay your employees and before the companies have paid you for your product. Where do you go to look for this? So far, we've talked about how to figure out your needs, how to sort it out, how to kind of plan for it. Now we're going to talk about where you go. There are a variety of sources of capital. Every one of these has its pluses and its minuses. Depending on what you're doing, some of these things may be great sources, some of these things may be terrible sources. So you really need to understand all of these sources of capital, what the pluses and minuses are, what your chance of getting them, you know, what do they look for. So the very first personal savings is the very first source of capital for most entrepreneurs. Frequently, you start using some of your own money to get a start. Sometimes you turn to friends and family, and we're going to talk a little bit more about that later, but you want to be a little bit cautious here. When I did iLink, I had many family members and friends who wanted to invest in iLink. I did not take their investment. The fear that I had was, of course, that iLink would go bankrupt. They would lose all their money, and they would then hate me for the rest of my life. I love my family far too much to have them hate me for the rest of my life. So I decided that I was not going to take an investment from them. Okay, that's one way that things can go wrong. The other way that things can go wrong is you don't take that investment from your friends and family. The company is very successful, as iLink was, and then they're mad at you because you didn't give them a chance to invest. To solve that problem, I gave some of my family stock in iLink as we went along, so that they each got a little something out of it, and we're not completely left out. That's a tough one. Lots of people do it, but all I'm doing is saying be a little bit cautious. Crowdfunding. That is a fairly new way to fund your startups. The Kickstarter, Indiegogo, GoFundMe, all different places where you can go and get crowdfunding. I'll talk a little more about that later, so I'll kind of skip through some of these because I'll have a chance to get in detail on each one of them as we go forward. Bootstrapping is when you basically start selling stuff while you're making it and hoping that the money flows in fast enough to keep you alive. That's called bootstrapping. You might go to a business angel. These are usually wealthy investors, older, have been successful individuals who will want to invest in you. Venture capitalists. These are more organized. They invest a little later, and they're usually groups of people. Corporations can invest in you. We had an investment, as you saw, from several corporations. Intel was our largest investor of the corporate type in the iLink. Great source of funds for us. Banks are tough. You can borrow from a bank, but they oftentimes make you have personal guarantees and so on. The Small Business Administration has a guaranteed loan program. This is not really a source of capital, but to avoid spending a lot of money on facilities or equipment, you can lease it, and so that frees up capital. There's also government grants out there. There's the SBIR, Small Business Innovation Research Centers, and the STTR, the Science and Technology Transfer Research Program, which provides some funding which can help you bring things to market. Okay. As I said, family and friends is something you have to be a little bit cautious with. Sometimes they call it friends, family, and other fools. Bootstrapping, I talked about this when we did the iLink case, because in fact we saw that iLink was bootstrapped. We began selling software, selling vaporware. Success Magazine laughed at our model, and they particularly found it intriguing because it actually worked. Everybody said it wouldn't work, and it worked. It might work for you. It doesn't usually work, but it worked for us. It was kind of selling vaporware. We went out and we said, well, deliver this software, which is going to be the greatest software you've ever had, will completely transform your business, and we'll do that next year if you give us $300,000 today. Success Magazine said we sounded like Wimpy. They called it the Wimpy model. If you've ever watched an old Popeye the Sailor Man cartoon, he had a friend named Wimpy, and Wimpy was always walking up and say, I'll gladly pay you Tuesday for a hamburger today. We just said, I'll gladly give you Software Tuesday for a $300,000 order today. It worked for us. And sure enough, IBM, Office Depot, News Corp, Sprint, AT&T, Aetna, United Healthcare, and others did buy our vaporware, and we were able to start with bootstrapping. It worked fine. If you do that, you better avoid any unnecessary expenses. You better be able to obtain those payments in advance. You do a lot of applying for and obtaining grants. We did have an SBIR grant, and was much appreciated. We shared office space. We used the incubators at Rensselaer Polytechnic Institute. We moved through 3 different versions of their incubators with increasing cost each time as we grew. Coordinating purchases with other businesses, using the incubator helped us to do that. Buying used instead of new equipment, leasing instead of buying, and really minimizing your personal expenses. For me, I had a full-time job as a professor, so that it was a little easier for me than it was for Mark Bernstein and Derhan Uslawel, who were at the time just new graduates and did not have lots of sources of other funds. They had a very tough time. They postponed having children with their wives. Both of them had, immediately had children as soon as we took the company public and sold the company. And they bought new cars when we did that. Up until then, they minimized personal expenses. As I say, crowdfunding is a fairly new way, and it might be useful to you. It was originally designed for our creative ventures, but has increasingly been used for other kinds of ventures. They kind of focus on creative ventures, theater and art and so on. But there are now crowdfunding sources for everything. And you can even have a site called GoFundMe that's mostly used to raise funding in personally difficult times, but it's also used to jumpstart certain kinds of ventures. Indiegogo raises funds for an idea, charity, or a startup business. They all support themselves by charging a commission on the funds raised, often about 5%, and they can also raise funding by charging for services that they provide you or advertising that they provide you. Another way to finance is through debt. That's pretty difficult for a new venture because you don't have really any credit rating. So you have to use your personal credit rating, and that's pretty dangerous. It has to be guaranteed by your personal assets. Um, but it's possible to do some debt, and we did some debt in iLink. As you saw, as soon as that debt began to get a little large, and we got too nervous, we went out and raised venture capital so that we could work with venture capital instead of the debt, and that meant that we gave up a portion of the ownership. We gave up equity to the venture capitalists when they involved. And the nice thing about that is you don't have to make usually you don't have to make scheduled interest payments until you have positive cash flow. So the equity terms are given in a term sheet and are something that you have a chance to negotiate. Okay, just to recap, first of all, you find out how much you need. Then you figure out how you're going to get it, whether it's equity, it's a liquidity event, selling the company, whether it's debt financing. Um, you have a strategy, an elevator pitch, a business plan or business model canvas, or a hybrid business plan, and so on. You find the best prospects, um, oftentimes with a personal introduction, and sometimes you need the complete business uh, plan to close the deal. Okay, you can see that I love spring training. I've had the unique opportunity to throw out the first pitch in spring training quite a few different times. And so every time I think of developing my pitch, I think of the practice that I did to make sure that I could throw the ball over the plate when it came time for me to throw out the first pitch, which I managed to do. Your pitch, on the other hand, is going to look a little different. Here I describe a 60-second pitch, but it can be a 2-minute pitch, a 3-minute pitch. Your investors will tell you what they want. But you want that elevator pitch or the rocket pitch uh, to go to them, to tell them enough about the company in that 1 or 2 minutes. And you have to decide on the pitch what the most important things are. I give you 12 slides and say, here's 12 slides you can have. Don't use 12 slides. 12 slides is crazy. It's way too much. But I can't tell you which of the 12 slides you're going to use because it depends upon your product and your investors. These are the slides you're going to prepare so you're prepared to pitch. But when you do the pitch, you're going to pick out the most important ones to make your case to that investment. The most important part of the pitch is the ask. If you're not there to ask for something, then why are you wasting your time telling them about it? So be sure that you don't sit down without the ask. You're asking them to invest, perhaps. You're asking them to buy. You're asking them to partner. Whatever you're asking for, you have a specific ask, and make sure that that gets out there. Okay. Now, let me check a little something here. I was just trying to see how we're doing. Doing fine. Where do you go to get equity funding? Well, you can go to the angel investors and venture capitalists, or you can go to the markets if you're ready for that, an initial public offering, where you offer a stock for sale to investors publicly. And if you're doing that, the bar is much, much higher for those kind of investments. For venture capital and angel investors, these are what are called qualified investors. And so they will invest, they can invest because people assume that they know what they're doing and they can't get hurt too bad. You can't sell your stock to the public, though, because you only can sell your stock to the public if it's registered properly and that you have basically assured the government authorities that this is a real investment which has reasonable chances for success. Investors are always looking for an exit strategy. So if you're going to tell them, I want you to invest $2 million into my company and I'm going to run that company for the rest of my life, they're going to ask you, well, how do I get my money back? As Mr. Wonderful does on Shark Tank all the time. So they're looking for a great venture with motivate and a team. As we said, um, as several people have said, an A team with a B product beats a B team with an A product. Whatever the merits of that, we like an A team with an A product. They are looking. We know the investors prioritize the team, and they're looking for motivation, passion, honesty, experience, but they're also looking for a great business opportunity with a large market, an appropriate growth strategy, a compelling product, and a product that solves some need, that takes away somebody's pain, and that has a competitive advantage so that it'll stay around for a while. I've already described business angels as individuals, wealthy individuals. They're oftentimes older toward the end of their career. They may not want to be starting up their own new company, but they're glad to use their experience to help you start yours, especially if they can profit from it. And they tend to be early stage folks. Venture capital is something that, as we can see in this graph, goes up and down over the years. And we've talked about this graph, the great growth during the 90s, during the dot-com boom, the great growth that has come again in the early 2000s, and at least the second half of the 2000s, and still going on. Boy, you can really, yeah, some things can really fly. Here was a picture of a group of legendary startups that I'll let you peruse on your own. I took this from as under fair use, from The Economist, The Empire of the Geeks. It's footnoted uh, to their work, and you can see a variety of companies. It's interesting that Theranos, which is the second from the bottom there, has been in the news recently, and we have a case on that. That was something that became a company that got started, was a gazelle growing so rapidly, became a unicorn with over $1 billion valuation, is now a unicorpse, meaning it has collapsed and burned. Um, it's increasingly a global opportunity. This is global market value of new things, particularly in China. So this is something for you to peruse on your own to see the places where there are these global unicorns, and so on. But it's also something that happens right here in Massachusetts. Venture capital invested in biopharma in Massachusetts is going up. This has become a key area of entrepreneurship in Massachusetts, one of the toughest areas, but there it is. It turns out that Massachusetts is a pretty good place for venture capital. We fight it out for second and third place with New York. California, far and away, is the place for venture capital, which is why, unfortunately, we see many new ventures going out to California. Facebook was founded in Massachusetts, went to California, is now a California company. That is not at all unusual. The availability of venture capital there is amazing. It's not a bad place to be. But Massachusetts, New York is pretty good. After that, it drops off pretty rapidly, with some in Texas, some in Washington, some in Illinois. And after that, venture capital is hard to find. This is a real startup about a story about Staples, the startup of Staples, and it happens to also involve the former Massachusetts Governor Mitt Romney. Before he was governor, he was a venture capitalist working at Bain Capital, and he was a pretty astute investor, did a pretty good job on that sort of thing. He was an investor in Staples, and this great article, which I encourage you to read and is all footnoted here, talks a little bit about the funding. The things I'm pulling out of this story, though, was about investing on it, because it was 1987, and Mitt was in a store, and he was mad that it wasn't working the way Staples told him it was going to work. He thought they needed to do a better job. And that kind of describes a venture capitalist. When they invest their money, they have expectations of you. they think they're driving you to success, and frequently they're not gentle about it. The article really talks about the difficulties setting the value for the company too. A founder always thinks their company is incredibly valuable. The venture capitalist, on the other hand, says, not so much. And you certainly see that playing out on Shark Tank. In every episode, there's usually a fight over the value of the company. And the same thing was true of Staples, as Mitt Romney said. It was a very difficult and painful process. He'd recall, we found Tom difficult to deal with from a negotiating standpoint. Well, guess what? That's because Tom Stemberg thought Staples was worth a lot of money, and Mitt Romney didn't want to spend a lot of money. Stemberg and his lawyer were driving a tough bargain, trying to keep a very large portion of the company. And the investors were thinking we should take a large portion of the company. It was clearly our intent to reward Tom handsomely if the company did spectacularly well. On the other hand, we did not want Tom to receive any reward if he were turned out not to be an effective chief executive officer. Yeah, right. Okay, so venture capitalists can be pretty tough. It's pretty standard. Um, okay, it always comes down to that point and finding the proper valuation. If you ask for too much, you'll often see the venture capitalists just walk away and say, this person is not a good business person. If they were a good business person, they'd know what their company was worth, and they wouldn't ask for such a ridiculous valuation. On the other hand, if you go in and ask for too low a valuation, they'd be more than happy to give you the lower valuation, and you left money on the table. So figuring out the right valuation is the key. And we have a great course here at the University of Massachusetts in Lowell, and really on various campuses that talks about entrepreneurial financing, and a large section of that is how you value your new venture. Oftentimes funding comes in stages: seed, Series A, Series B, Series C, or second stage funding, mezzanine funding, which comes in just before you're kind of cleaning up the company to sell it, and buyout funding, which happens at the time of the sale, where you get some financing to work through the sale. Um, Venture capitalists also are funded by industry and by development stage. Some are early stage, some are late stage. It's hard to find early stage venture capitalists these days. You can find late stage venture capitalists much better. Um, Frequently, venture capitalists team up, and they think that if they have 3 or 4 venture capitalists and you have 3 or 4 pairs of eyes, you're more likely to avoid risk and diversify your portfolio. That's all good. We talked about debt financing and how difficult it is to get. That's usually something for more established companies, but you can go to banks and get them to say yes. If you can overcome the things that a bank likes to say, like, we don't make small business loans, I don't know about you and your business, you haven't really explained why you need this money and what you're going to use it for, your numbers don't support your request, you don't have enough collateral, your business does not support the loan on its own, you've got to have questions for those. And as I said, I was able to convince a bank to give us loans, but I had to make personal guarantees to do that. I'm going to skip over the personal story, the funding of iLink. I'll just say a few words about it. When I became the president of UMass, the governor, then Mitt Romney, and I were talking in his office, and he was excited that I'd become the president and said, this is going to be great. I'm looking forward to working with you, and so on and so forth. But he said, this is a huge enterprise. You've got 85,000 students. At that time, it was a $2 billion a year budget. It's now $3 billion. He said, there's a lot of stress on this thing. You're going to be up to all stress? And I said, well, Governor, when I was the CEO at iLink, I was borrowing a lot of money that I could never pay back, and not always fully disclosing to my wife and kids that their house and their future college educations depended upon my ability to pay off these loans. That's stress. that is stress, and being a president doesn't compare to that. Okay, the story is just to kind of help you understand that loans are something that you should, think long and hard about and be comfortable before you jump into it. Small Business Administration gives loans. You can find the details here of the kinds of loans that are guaranteed by the Small Business Administration. It's a good source. And about half the banks in the United States participate, and they might guarantee as much as 85% on the smaller loans and 75% on larger loans. Um, the the things are always changing, so you're going to have to get the latest guidelines if you're interested in that. If you have a technology program, the SBIR and Small Business Technology Transfer programs are really, really great programs, which we use because they can provide cash grants that don't have to be paid back to entrepreneurs working on projects in specific areas. They usually do it in a three-phase. The first phase, you get a small amount of money to kind of show that you can do it. The second phase, you get a larger amount of money to bring it close to market. The third phase is you're bringing it to market, and you don't get any money for that, but they expect you to do it. Here you can get more detail on the SBIR, the three-phase program, the STTR, and they have links of the three-phase program for the STTR. I've talked about leasing already. No need to talk more about that. Let's talk a little bit about exit strategies now. I do want to take a little more time on that, even though we've hit this many times during this course. The venture capitalists, the angel investors, they're going to want to get their money back, which they usually do by selling the company or by doing an IPO, the initial public offer. And if you do the initial public offer, then they can sell their stock in that public offering and get their profit. If your company is sold, then when whoever buys your company pays them off for their share of the company. They're both good ways to go. It's easier to be acquired than it is to do an IPO, and that happens probably far more often than doing an IPO. You hire an investment bank in general to help with that. It's an enormously complicated process, and you need a lot of legal help with it, and the investment bank underwrites the offering. You create a preliminary prospectus, a final prospectus, and you go through the roadshow or a series of presentations. You also have all sorts of legal requirements on what you can say and what you can't say. I've got a link here to many different roadshows, which I encourage you to go and watch a few of the roadshows. You will need legal representation to keep you out of trouble as you do that process. Things can go very well and things can go very badly, and even if they go badly, they may turn out fine in the end. Facebook's IPO was not a great IPO. Okay, looked like it was going to be a great IPO. The links are here, by the way. The share price, $38, valued the company $104 billion, pretty good. Largest valuation ever for a new public company. But during the roadshow, you're required to tell the truth, and the truth was that they were suffering from pressure on earnings due to the mobile platform. It just happened to be at a bad time. It scared investors, reduced the demand, and the price fell precipitously over the following year. And people thought, oh my goodness, this is a total disaster. Well, you can have a look at that graph there to see that it was not a disaster at all. And you can have a look at the graph since that time to today to see that it was probably a fabulous investment, even though it didn't work out during the IPO. Or you could look just in the last few days where Facebook is in deep trouble because of their problems with protecting user data and the fact that it was taken by a contractor, Cambridge Analytics, a Massachusetts company, I hate to say it, that was working for the Republican Party, and Facebook shares have fallen rather dramatically. There's other IPOs that you'll want to look at. Just a few words about the nonprofit organization. They also have to be funded. But the sources of funding that we've talked about here are not usually available to the nonprofit organization because there's no way for an angel investor to cash out. There's no way for a venture capitalist to cash out. Banks don't like to lend to them unless they have a history, and they can't have any profits anyway. The thing about a nonprofit is you're prohibited from self-inurement, which means that the people working in the nonprofit cannot really benefit or profit by the company. It doesn't mean you can't get a salary, but you can't kind of set it up so that if the company is very successful that you make $1 billion or something. And so those who contribute the funds to this have to take their profit by being excited about supporting your nonprofit venture. Okay? So frequently donations are the largest source of funds, but many nonprofits or for-profit social enterprises fund themselves also through revenues of services that they sell or products that they sell. And it has to be sustainable. If you don't have a margin, and you don't have a mission. I've mentored many people that want to start a social venture. They say, I'm not interested in finances, but I'm only interested in the mission. Okay, good. That's wonderful. So how are you going to pay for that mission? That's usually when they give me a dirty look. They don't like to hear that, but that's the fact. The joke about a president of a university, it says, president's university, there are people that live in a big house and they beg for money, which is certainly true. Sadly, the president of the University of Massachusetts did not get a big house, but they didn't even get a house. But like most presidents, the president spends a lot of his or her time in meeting donors and asking for donations. That is how I spent my spring break last week, was meeting with many of those donors. And fortunately, many of them have given us more donations, and many of you, the students, have been profiting from that by having scholarships that are supported by those donors. Usually you have professional fundraising personnel. Okay, so I was just trying to say that here's a bunch of examples of places that you can go to for funding those nonprofit or those social ventures, and I'll let you just work through that on your own. The point that we come to then is the happy ending. Yes, I had to pose with a World Series trophy. That was a happy ending in 2004 for us, after 86 years of trying. And for those of you that were born and raised in Boston, Massachusetts, you've probably grown up with your parents telling you about the years of travail that they had waiting to win a World Series. And in 2004 it happened. Here's the World Series trophy. When your new venture gets funded, you may not win a trophy, but you'll feel like you won the World Series. And that is all a good thing. So, all right. So that brings us, back to the ending of this section on finances. As I said, this is a pre-recording made in case the bandwidth doesn't stand up to our needs when I'm broadcasting from Cuba this week. But I'll be doing my best to broadcast from Cuba on Wednesday night, and I look forward to seeing some of you online and to answering your questions. And lastly, I remind you one last time that this week the projects are due, the hybrid business plan, and the pitch, the video pitch, is due, and next week will be your final exam. So good luck, have a wonderful week, and we'll see you all next week. Thanks a lot.